Now, economics, one of the most easiest topic. You'll have around one or two beginners, right? The same proportion, the weightage is the same that you have for derivatives or the other topics. However, the good news is that only two readings and therefore it's going to be very high scoring. Okay. One beginner for sure, and then you might probably be getting some random questions, three, four questions, right? Individual questions. Now, the first topic is about the currency. The second topic is economic growth, where you're going to be having a lot of theories, right? Different types of growth related formulas as well. Currency topic becomes much easier if you do this after derivatives, because here there is going to be currency gain loss, which you will be calculating based on your forward calculation that you did in fixed income and so on. So this topic, even though it's quite lengthy, but in reality, when you summarize it, you will not be taking too much of time. In fact, I have seen that, in the full course where we spend around 5 to 6 hours, but when you go to revision, it's going to be relatively very quick. And here, one very important formula of arbitrage, the shortcut formula that I had given in the class, that is going to be very handy. So let's start with that. First, initial part of the equity went on to discussion of what is the base currency, what is the price currency. I will buy, the bank will sell at the higher rate, that is the ask rate. The dealer will sell at ask rate. The dealer will buy from us at a lower rate, that is bid rate. The difference between both is spread, and these spreads, if the currency rate is in 4 decimal, they are in pips or points. All right. This pips or points also helps you to identify how to get the forward rates from the spot rates later on. In currency, the most important discussion is going to be about the cross currency. I'm sure you need to know how to, first of all, converting into spot rates. That is very easy, but the cross currency is the most important concept. So when you do the revision, you can actually start doing the revision directly from the cross currency rates. Cross currency rates is where you are going to combine two currencies and you're going to get the third currency, that is the combined currency. This cross currency helps you eventually to do the triangular arbitrage, which I feel has a very high chance of that being asked in exam. Remember, in triangular arbitrage, what happens that the two quotes are given to you, and sometimes there are three quotations that are provided to you. So we had done the triangular arbitrage in some of the cases where we will be probably provided with three quotes. Now, those three quotes, out of that, you'll have to cross any two quotes and compare it with the third. This triangular arbitrage process, you don't have to do the lengthy process. All you have to do is that you have to identify the bid and the ask at which you're going to do the arbitrage. This is where I will show you in the calculation how this arbitrage is done, where I've provided you the shortcut. So instead of doing the long process here, just giving you a hint, because more discussion will do when I show you that question in the beginners that we are going to solve. But here, when you cross these two rates, right, the dollar is the common currency which gets disappeared. So all you will have is the Mexican, let's say an Australian dollar in this case. This you compare it with the rates that they've provided, and accordingly we will do the arbitrage. Here you're going to compare ask rate of one with the bid rate of another. Ask rate of one with the bid rate of another, because ask is the rate at which you will buy and bid is the rate at which you will sell. So the buying rate should be lower than the selling rate. If that is the case, then there is going to be arbitrage gain. Just to conclude, the arbitrage gain is going to be the same irrespective of whichever currency you take into consideration. All right. More detailed discussion of this is what when we will have the case studies or when we'll have the beginners, right? Remember the formula here: identified bid over identified ask minus one into the capital that they've provided you in whichever currency. That's going to be your arbitrage gain. This is going to be the most important formula, which I will utilize in the question, and we will see how faster we calculate the arbitrage gain. I expect a very high chance of something related to triangular arbitrage in exam. Okay. Then we went into the discussion of what is a forward premium and discount, and this premium and discount are added or subtracted if it's discount. But you need to check if the currency rates are in 4 decimal, the points, whatever the points are, you need to divide it by 10,000 and then add or subtract to find the forward rates. Clear? Now, the most important thing about this topic, which has a very high chance of that being asked in exam, is how to find the mark to market gain or loss. Now, when you trade the currency in forwards or futures, right? You forwards especially are executed only on maturity, but what if you want to exit the contract before maturity? So at that time, you'll have to find the rate relevant for that period. This calculation is very similar to what we did in derivatives, where we were trying to exit the contract before maturity. So here your derivatives knowledge of forward will be very helpful. Okay. So whenever I'm going to do the mark to market, right, you will have to compare the two rates, the forward rate that you booked at initial and the forward rate which is applicable at that point of day. Remember here the forward is of the currency which is based on the principle of on the principle, either they will provide you that rate or you can find that rate using the interest rate parity, isn't it? What is interest rate parity? Forward equals to spot into 1 plus the rate of the price currency over the base currency, 1 plus interest rate of base currency, which we are going to see it in a moment. This forward rate, and simultaneously I have put that in the formula here. So spread and all this is fine. Cross rates, triangular arbitrage shortcut I've put here. But when it comes to the mark to market, this is the most important formula. The forward or the future price at point T can also be derived using the interest rate parity minus the forward that you booked into the notional principal here or the contract size. Instead of notional principal like bonds, here we are going to do the contract size. But remember, the forwards are settled at a different period, not at the end. So you need to bring everything to the present also. Same way like we did in the derivatives. All right. So here, everything will be multiplied with the contract size of that derivative, which will be provided to us. This type of question we are going to see. Very, very important here is that when you're going to discount, remember the base currency is always in terms of price currency. So the discounting, the borrowing cost or the opportunity cost, the rate of interest you're going to consider is of the price currency. The discounting is going to be on the basis of price currency. Everyone with me on this? Understood? Understood. It's on the basis of price currency. Remember, I have given you the slogan that throughout the currency, always think from the point of view of base currency only. Everything is from the base currency. The second currency is the base currency. Price slash base is the format. So everything is going to be spoken about the base currency. All right, all right, all right. Clear about this? Check, check, check. The discounting has to be on the interest rate of the price currency. Is this clear, everyone? Right? This has a very high chance of being asked in exam. The rest, as I said, is based on the parity, the covered interest rate parity and the uncovered interest rate parity. Basically, all you need to know is that through the interest rate parity, you can get the no arbitrage forward rate. 1 plus spot into 1 plus interest rate of price over the base currency. But remember here, if the interest rates are if you're trying to find out the rate for 3 months or 6 months, you need to adjust for those days as well. The only difference between covered and uncovered is that covered is bounded by the concept of arbitrage, uncovered is not. So there is a discussion about this covered and uncovered. The rest of the things you can ignore. Where is this discussion? There is a comparison between both. Where is the comparison? Yes. This is where we did the comparison between the both. What is the covered and uncovered difference? Honestly, when it comes to calculation, there is no difference. Interest rate parity concept is the same. Forward equals to spot into the ratio of 1 plus interest rates. However, covered, the word itself covered means you are going to use derivatives. So covered assumes it is based on the assumption of arbitrage, but uncovered is not. Here, very important, if the forward rate and the expected future rate, if they both are said to be the same, then We call the forward rate as an unbiased predictor of the future rate. This is most important. Okay, this might be asked in a theoretical point, right? So the parity is based on the concept that the forward rate and the expected future spot rate, they both are going to be the same. If that is the case, then the forward is reliable, or you can say it's an unbiased predictor. All right, correct. Also remember, we had discussed that uncovered parity does not hold in the short run. All these parities hold only in the long run. Clear, 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 clear. What is the formula that you need to take from here is the interest rate parity formula. All right. Uncovered actually means that the expected spot is nothing but the interest rate difference between both the currencies. So the premium or discount on the rate is actually due to the interest rate difference. So the country whose interest rate is going to be relatively higher will be trading at a discount. So country whose interest rates are relatively higher, its value will be at discount in the future, or it will be depreciated in the future. So remember, as per the parity, the country who has relatively higher interest rate, its currency should discount by approximately the same difference. And why is there an interest rate difference? This was cleared by the Fisher relationship. Fisher said that the difference in the interest rate between the two currencies is due to their inflation difference. So if one country has a higher inflation compared to another, that's the entire reason that why their interest rates are relatively higher. All right, everyone, is this clear? Clear, 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 right? So what is that needs to be matched between the two countries? Their real interest rates should match. Only then I can conclude that the inflation difference is the cause of the nominal rate difference. So the real rates across the economies should be same. That is the concept. That is the most important thing of international Fisher effect. All right, everyone. Check, 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 check. So in our formula also, we've concluded this, that the international Fisher effect says that the difference between the two countries' interest rate is due to the inflation. See here, the Fisher effect, the difference, the real rates are same. So the difference is due to inflation, inflation, right? Right, right. Covered and uncovered, both are based, covered is based on arbitrage, uncovered is not, correct? So here they both, if they both are same, it's called unbiased predictor. All right, we've written that in the formula notes as well. We just discussed the Fisher. The purchasing power parity will also give you the expected spot or forward rate. Just remember that instead of interest rate, you're going to replace that with the inflation index. Inflation is CPI, the consumer price index, which is the retail inflation. So instead of interest, you can use inflation, and inflation will tell you that the country whose inflation is relatively higher will be at a discount in the forward or futures. So instead of interest, we can here blame the inflation to be the reason of premium or discount. So remember, country whose interest rate or inflation is higher will be relatively at a discount in the futures or forward. Okay, this is a very, very important conclusion of purchasing power parity or interest rate parity. Just to give you an idea that the PPP and IRP, they both are connected. Why? Because the interest rate difference is due to inflation, which is what purchasing power parity is. Understood this conclusion, right? The rest of the discussion is not so important. All right. Okay. Now we went on to the discussion of the carry trade. Remember, what is a carry trade? Carry trade is a situation where you are going to borrow from a low interest country, convert it, convert it and invest in the foreign country. That's how you make the interest rate difference. You capture that interest rate difference. Now, so here we have an assumption. What is the assumption here? Assumption is the violation of uncovered parity, because what did the uncovered parity say? That if you're going in another country for capturing that extra interest rate, that is disappeared in the currency depreciation, right? But they are saying people are able to make money in forex carry trade by borrowing in one country and investing in another country If they are able to make profit, then it's a violation of your uncovered interest rate parity. In exam, if they ask you to do forex carry trade, you will always borrow at the currency which is the cheapest and invest in the currency which is highest. All right. And the interest rate difference will be your the interest rate difference minus any cost of funding, okay, or any depreciation in the currency. That will be your benefit. So any changes in the currency rate, right, depreciation, that will be adjusted from the interest rate difference. This is going to be your profit, and then any currency depreciation will be adjusted. Here we are assuming that if there is a profit, means the uncovered parity is not matching. Otherwise, the interest rate difference and the currency appreciation or depreciation should be the same, isn't it? Clear? Remember one thing, carry trade is not foolproof. There are also risks, and sometimes this risk can turn into extreme events. So there is negative skewness and kurtosis. If there is an economic crisis or very uncertainty, then you can completely lose huge amount of money. All right. Then in this topic, we moved on to the third section. First section was about currency, cross currency and arbitrage. The second section was about the parity. The third section, we moved about the macroeconomics point related to currency. Currencies are dependent on macroeconomy, especially balance of payment, which has current account and the financial or capital account. This is current account is related to imports and export, that is trade, and financial account is related to interest rates because it is about borrowing and lending. All right. Remember, why is it called balance of payment, balance of payment, balance of payment? Why is it called? Because current account deficit will be compensated by a capital account surplus, or vice versa. If the current account is at surplus, capital account will be at deficit. So therefore, the equation should always balance. Everyone with me? Correct, correct, correct. Current account is related to trade, capital account is related to inflow and outflow, and a deficit in one should be matched by a surplus in another. And if the current account is going to be deficit, right? And what will be the immediate effect on the currency? The currency will depreciate. Understood? So depreciation of the currency is going to affect your trade. Clear? So current account deficit will lead to depreciation of domestic currency, and what all issues will happen, that's what we discussed. That flow supply demand mechanism, it will in a country increase the supply of that currency, as exporters will find it beneficial, right? Because their goods become cheaper in the foreign market. Here, remember, other things also matter. How much is the size? The decrease may restore the current account deficit to balance. Whether the country will be able to restore this deficit or not, it depends on three factors. What is the size of initial deficit, the influence of exchange rate on the export import, and the elasticity's impact on the export import. Three things. Understood? This is the flow fund of, the supply demand mechanism. Portfolio balance mechanism says that country with current account surplus usually have a capital account deficit, right? And vice versa. So this is the reason what will happen, that eventually it will balance out. Okay, so you should not be concerned about high current account deficit, because that will be compensated by a current account surplus. That's the flow of capital concept. Understood? Debt sustainability mechanism is that a country which is having a very high current deficit, or its debt to GDP ratio is substantially very high, will find it difficult to borrow. Okay, so here we need to check the level of debt and as to how high it is compared to the GDP, because in that case, if it is not sustainable, the currency will go on a complete downfall, a huge depreciation will happen. So currency can be badly affected by these factors. All right. Capital account. When it comes to capital account, what happens? Whenever the capital account is at surplus, means there is too much of fund in the system, right? Correct. So capital flows into the country may need to overcome a shortage of internal savings. So if the country has less savings and more money is needed for expansion, the capital account needs to be surplus. And for that, you will have to raise the interest rates so that people can find it lucrative to invest. Understood? Everyone? Check, 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 check. So differences in real rates will cause people to come and invest. And that is possible when the real rates are higher. So higher real rates will attract the foreign capital and therefore the capital account surplus. All right, correct. Then we went on to understanding how different factors affect the currency. This topic was so long. So monetary and fiscal, how they affect the currency. Here we had different approaches. Under the Mundell-Fleming approach, we look out at the short-term impact of interest rates on the currency. Are you there with me? Correct? Now, Mundell-Fleming said the short-term impact of monetary and fiscal on interest rates or exchange rates, it assumes that there is sufficient slack in the economy to handle changes in aggregate demand and that inflation is not a concern. Means they don't blame the inflation for the exchange rate. They rather say that inflation is independent. The currency exchange impact is independent of the inflation and you should not be concerned about that. Understood, everyone? That is the Mundell-Fleming approach. Under this, we discussed about the flexible or the floating exchange rate system and the fixed exchange rate regime. Floating or flexible exchange rate regime is where there are two aspects that you need to consider. Whether the capital is mobile or not means this is related to monetary policy. Low capital and high capital mobility means, see, high capital mobility means capital can freely move unrestricted. Low capital mobility is opposite, restricted. Understood? So that is one thing. So monetary and fiscal policy along with how your capital is mobile, that together will give us some direction about the currency. So in this, we had actually made a table. You can see this, right? We've added this table. Where is it? Yep, the Mundell-Fleming approach. Let me add this. Okay. So, sorry. Yep. Okay. Now this table is very crucial. I'm just adding this table in our formula notes, which we did in the class. Very crucial because this tells you that what is going to be the overall impact under the Mundell-Fleming about the capital mobility and the monetary fiscal policy, right? So see here, if both are expansionary, what will be the value of the domestic currency? So here, the domestic currency, if both are expansionary, monetary and fiscal, both are expansionary, you want the economy to increase, right? In that case, sorry, what will be the situation? The mobility, if is uncertain and if it is low, there is a depreciation. So what is going to be the situation? See here, first, before understanding this, we need to understand that what happens in expansion and restrictions. Whenever there is expansion, what happens in monetary policy? The interest rates go down, correct? And the currency depreciates. But in fiscal policy, when I say expansion, what happens to the currency? The currency appreciates if the fiscal policy is on the expansionary roll. When the monetary policy is restrictionary, where the interest rates are high, whenever the interest rates are high, what happens? That the currency appreciates. In fiscal policy, if the fiscal policy is restrictionary, means the government will spend less, right? Charge more taxes. So the government spending is going to be less. In that case, the requirement of fund is less. So the interest rates are low. That will cause depreciation. Okay. This made things very confusing, right? When we were discussing about the mobility, rarely they do ask complicated things here. All you need to understand that how the monetary fiscal policy compare how that will they are compared to the domestic policy, just remember whenever both are expansionary, monetary and fiscal, both are expansionary, the currency depreciation will be the case. The currency will be depreciated so that the exports become cheaper. All right. And monetary policy is also expansionary. So the interest rates are already low. So people are not willing to invest in your country's currency. So therefore, here, if the capital is highly movable, then it is uncertain. But if it is less movable, right, in that case, the currency is definitely going to depreciate, right? If they are contradictory, it is the opposite. But if they are both restrictive, then the impact is definitely on the currency. All right. So whenever they are in the single direction, expansionary or restriction, what you need to understand that if the capital mobility is very high or low, high means what is high capital mobility? Less restrictions. Then the capital can go in any direction. But if there is a capital restriction, then the currency is clearly going in one direction. Either it is depreciating or expansionary. It's appreciating. Okay. Problem happens when there is high capital mobility, the relation becomes complicated. So then in that case, whenever there is high capital mobility, then monetary policy expansion means interest rates are low. So currency will do what? They will depreciate. Then when the capital is highly mobile and when monetary policies are restrictive, that means interest rates are high. So the currency will appreciate. Understood. So it is actually more related to how Mundell-Fleming approach basically discusses the impact, the short-term impact of monetary policy on the exchange rate. Clear? Also, there is fixed exchange rate system. Under the fixed exchange rate, it is the government which pegs the rate or fix the rate. So here, an expansionary monetary policy will lead to depreciation because the interest rates are low. Am I correct? Correct. So, world with mobility of capital, governments cannot manage both exchange rate. You can't do both. You can't keep the interest rates also low, and you allow free capital movement. That will not be the case. Okay. So the problem is that when there is a high capital mobility, governments can either do the independent monetary policy or they can let the currency flow freely. They can't do both. They can't manage the currency and they can control the monetary policy. They cannot do both. Understood? Correct. There were monetary models also apart from the Mundell-Fleming. They take into the effect of monetary policy on the exchange rate. See, Mundell-Fleming, what did the Mundell-Fleming do? They said inflation doesn't play a role. Monetary, they do assume that inflation plays a role. Correct? So, monetary policy is only focusing on the monetary approach. Portfolio balance only focuses on the fiscal approach. Now, monetary policy says that no, inflation does affect the exchange rate. If it affects immediately, it's called pure monetary. If it affects in long term, it is called Donbass overshooting model. That's all you need to remember. Portfolio balance approach, on the other end, focuses on the effect of fiscal policy. They say that relatively it is a fiscal policy which will affect the exchange rate. How? Whether the fiscal deficit, if the economy is into fiscal deficit, the government will borrow more or less. Well, the government wants to spend more, so they will borrow more. And as the government borrows more, the interest rate goes up and the domestic currency will appreciate. So the appreciation and depreciation is because of the government's decision about borrowing, and that is related to the fiscal deficit. All right. All right. We discussed the effects of central bank push and pull. The push and pull concept is basically how the country will have more or less capital and what will be the effect on the exchange rate. Pull and push factors. Pull is where the government is going to pull foreign capital, going to make it more attractive. And push is where, of course, the no government wants to push away all the money, right? So push factors are driven by international capital returns. Okay, so if the capital returns are less, then the foreign capital will move out. So pull is defined by the government. Push factors are based on international capital, how much returns they want. So relatively, how much are my returns? That is what it is based on. All right. Capital controls. Some countries prefer to control the capital. Why? Because they are worried about the exchange rate volatility, right? Finally, we discussed about the different signs of currency crisis. Very important this. This is where we discuss what are the different factors that can lead to currency crisis. Terms of trade getting deteriorated in the current scenario. Fixed or partially exchange rate that puts a lot of pressure on the central bank. Correct. Official exchange rate dramatically declines. Currency value has risen above the historical mean. This is a very important indicator because it's a technical indicator. If the current rates have gone above the historical rates, that means they will fall drastically. Inflation has increased, liberalizing capital markets. Whenever there is sudden flow of capital in 1991, when most of the Southeast Asian economies they opened up in the 90s, there was a huge movement of capital, and that was a good thing, but that volatility in the capital caused currency crisis, which is also called as East Asian crisis, Southeast Asian currency crisis. Understood? Money supply relative to the bank is increases. Suddenly, the money supply is flooded by the central banks. That also caused currency depreciation. We've seen that in Turkey. And of course, the banking crisis. People lose the trust in the banks. These are the important elements with respect to the currency topic. Everyone with me? A very lengthy topic, but it's okay. Only one topic is the bigger one. The rest is economic growth, which is relatively less, small in size. All right, understood the currency part? Okay. Now, coming to this topic of economic growth. In economic growth, the majority of the discussion is on the GDP growth rate. Here, there are several ways to identify the GDP growth rate where we are going to discuss the different parameters of what is a potential GDP. Potential GDP of a country means what is the maximum. Understood? So, what is the maximum GDP of a country? The upper limit of real growth for an economy, which is equal to the long term growth, right? So, is the long run limit of earnings growth. So, no country can grow higher than this. So, whenever I say potential GDP is nothing but the maximum that an economy can grow, which is equal to the equity growth rate of the country, right? Which we did learn in the Greinhold-Kroner model also under equity. So it's the same thing. Greinhold-Kroner model, remember, we used for risk premium, where expected return is dividend yield plus capital gains yield, which had three combinations: change in PE, change in the nominal growth rate, and the changes in the shares. Correct? You don't have to revise the Greinhold-Kroner model again, so you can skip that discussion here. Greinhold-Kroner model, we've already discussed that in equity. All right. Now, most of the discussion is about how the GDP will increase, what is going to be the impact. So let's go on to that. Okay. Yes. Factors and inputs of economic growth. This is very important. And this is where we have some of the formulas. We've done the Greinhold-Kroner model. And the most important formula that is going to come up, there are several formulas leading to how to calculate the labor, how to calculate the effect. We are going to take into consideration what is going to be the effect on the output or the GDP. So there are several formulas here. The GDP is a combination of three factors of production: total factor productivity, that is due to technology, labor, and capital. But labor and capital is based on the proportionate share of labor and capital in the economy. Here, the alpha represents the share of capital in the economy, and 1 minus alpha is the share of the labor in the economy. All right, this is going to give you output. But are we interested in output means GDP? Are we interested in GDP or GDP per capita? GDP per capita is where you are going to derive output per worker, where whatever is your output divided by the labor, then your formula turns out to be total factor productivity plus labor gets disappeared, capital per unit of labor. This is where we discuss, when I say capital per unit of labor, this is where we discuss capital deepening. What is capital deepening, guys? Capital deepening means there is a scope that by adding more capital, the economy, the GDP can rise. Now, remember one thing, capital deep for a developing country who is dependent on labor, higher labor will increase their GDP. Higher capital infusion will also increase the GDP. But remember, for a developed country, they are not dependent on the capital. They are already having enough capital allocated. So, what is capital deepening concept? You're going to tell us that technology is the main source of growth for a developed country. But for a developing country, there is still a scope of increase in the GDP using capital. So remember this discussion for developing country and for developed country. Okay. For developing country, capital deepening will result in higher growth. For developed country, all the growth should come from technological progress because they are already overspent. They are already having enough of capital deployed. So one very important thing that we discussed here is this: developed countries capital per worker ratio is relatively high, so they have very little to gain from capital deepening and they rely on technological progress. Developing country, they still have scope. Okay, this is the most important conclusion amongst all. When it comes to the formula, you need to remember the Cobb Douglas production function, which is change in the GDP, similar to what we just saw. But here there are three factors of production: total factor productivity, that is technology, capital, and labor. So change in capital, change in labor. But remember, capital and labor are denoted by the proportionate share of capital and labor in the economy, because not every country is capital intensive, some countries are labor intensive. So how much is the proportionate share of that? All right. Here, to be honest enough, total factor productivity is difficult to identify. So actually, that is the balancing figure that we look for. This, when translated into percentage, it is long-term growth in technology, change in capital and labor, or the growth in capital and labor times the alpha and 1 minus alpha. Alpha is here the elasticity of output due to capital or labor. Okay. High chance of Cobb Douglas production function or growth in potential GDP to be asked in exam. Okay, this is one of the most important formulas, the Cobb Douglas production function. This is more important. Okay, clear. Long-term growth in technology, long-term growth in capital, and long-term growth in labor. Now we discuss what is this growth dependent on. Technology and capital. Technology and capital is going to increase the labor productivity. Labor productivity, as I said, can be improvised by capital deepening and technological progress. But growth in labor is based on several factors like population, immigration, and so on, right? Or participation rate, which we will see. Together will lead to growth in potential GDP. So now we are going to go deeper into the factors, each and every factors. How do they increase the GDP? Okay. So throughout the syllabus, first we discussed here how is natural resources. Having natural resources is of course going to increase the GDP, correct? Because that's going to be additional source of factors of production. Then we discussed about labor supply. How can the demography, labor force participation, immigration, or number of hours work, the more of these factors, the more the number of hours work, the more liberal immigration policy, the more participation rate, all of that will increase the labor, which will eventually contribute to increasing the potential GDP. Understood, everyone? Then we discussed how investment in physical, human, and capital and technology, how often all of that will increase the potential GDP. Human capital is skill and knowledge. physical capital are two forms, ICT and non-ICT. What is ICT? ICT is infra, computer, and telecom. Remember this. So ICT and non-ICT both come under the physical capital, right? Correct? Now, the research has found a strong correlation. So the more capex, the higher will be the growth rate. Clear? But remember, this again comes the capital deepening concept. For countries which are already highly capital intensive, like Germany, for them, there is less scope here from by increasing the physical capital, there is less scope of increasing the GDP. For those countries, research and development and all the technological development can result in the growth. Public infrastructure, by creating public infrastructure like highway system or fast railway system, that will also, of course, naturally increase the GDP. Clear? 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 Okay. Now we move on to those factors which are endogenous growth theory, right? And we will see along with that classical and neoclassical growth theories. Very high chance of, if something is to be asked on this topic, they might ask you something about the different theories of the growth. So what are the different theories of growth? Classic growth theory, here they said no country will have increase in per capita GDP. It contends that growth in real GDP is not permanent. No country will grow forever. Any country which is growing at a higher rate will eventually come back to the come back to a specific level which is called subsistence level. It is the minimum income needed to maintain. Classical growth contends that growth in real GDP is not permanent. Understood? Because population explosion will capture all the additional advantage. So no country will grow at a high rate forever. This theory does not hold true, especially when you take the case of China. On the other end, neoclassical growth theory says that if here they actually are in opposition to the classical growth theory. Here, the primary focus is on the economy's long-term steady growth rate. And when output to capital ratio is constant, what is the important thing? Here, the population growth is independent of economic growth. So, unlike the classical growth theory, where they say population growth will happen with high growth and that will take away all your advantage of high growth, neoclassical theory does not consider population as a factor here. Understood? So rather it focuses on the growth theory of Cobb Douglas, where remember it's the growth in capital and labor also along with the technological that we take into consideration, right? So based on the Cobb Douglas, the neoclassical growth theory states two things: sustainable growth of output per capital and growth of output with sustainable growth rate of output and labor. This is very, very important. This is Cobb Douglas neoclassical growth theory. So I will write down here, it is not mentioned. Cobb Douglas neoclassical growth theory. Under this, we are going to eventually understand what will create sustainable growth rate. So sustainable growth rate is actually due to capital and labor. Understood? But sustainable growth rate here of output per capita. So it is sustainable growth rate of output per capita. Output per capita. Okay. So sustainable growth rate on output per capita is not only related to per capita but plus growth rate of labor. So if I want to find only per capita, I will take into consideration the capita rate. So basically here, if you look at it, if it is only based on capita, output per worker is equal to growth in technology divided by 1 minus alpha. What is alpha? Alpha is the ratio or proportion of, what is alpha? Alpha is the proportion of capital in the economy. Remember here, alpha. throughout the syllabus, when we say alpha, here alpha is the proportion of capital into the economy. All right. So if I want to find the growth based on per capita, right, it is technology divided by 1 minus alpha. However, not only on the basis of per capita, but if I want to include the growth due to the labor as well, so we need to add the change in the labor. So if you note here, it is also here plus changes in the labor or the growth of labor basically. These formula very important from your exam point of view. Okay, so this is neoclassical growth rate. Then we looked at the endogenous growth theory. What is endogenous growth theory? Now, endogenous growth theory, here it is more dependent on the technological growth. So whenever we are going to talk about technological growth, physical or human capital plays a very important role. How much of your investment is going to be research and development, that all plays a very important role. Okay, so what will happen? Technological progress will boost the productivity of both labor and capital. The neoclassical says that it will not be permanent, correct? Here they say that it can permanently increase the growth rate. So if you are constantly investing in research and development of human capital, or in skills, then it will constantly permanently increase the growth rate. So it's in complete opposition to the neoclassical theory. Understood. Neoclassical assumes that capital investment will expand as technological improves. Endogenous growth theory assumes that capital investment may actually improve the technological factor productivity. So it's investment, capital, which will increase the technological progress. Neoclassical, on the other hand, says that it will automatically happen. Okay. Now the growth comes from technological factor. Everyone agrees, correct? But in endogenous, they say that this technological growth will happen due to the investment in capital. Understood? Clear? So eventually we need to understand, can a country forever grow or not? For this, we understood a concept called convergence hypothesis. I know it's very theoretical, but yes, we did this. Convergence hypothesis means, will the poor countries ever become rich? That is a $1 million question, right? So there are large differences amongst the countries' growth, and some countries haven't been able to grow. The GDP is high, but the GDP per capita is not high. So absolute convergence says that yes, this will happen. Eventually, what will happen? Less developed countries will grow. They agree with this, right? But conditional convergence says that it will grow for countries with same savings rate, population growth, and production. But what is the condition here? That it will, under the conditional convergence, the growth rate will be higher for less developed countries until they catch up and achieve a similar standard. So, relatively, the growth rate will be higher. The less developed countries will grow faster, right? And here they talk more about the convergence in the living standard. And that is related to several factors like increasing the population growth rate or the savings rate. All right. Once a developing country's standard of living converges with the developed, the growth rate will stabilize at the same steady rate of developed. So then eventually you will grow. So both absolute convergence says it will happen. Conditional convergence says that it will happen if you meet those criteria. But then the third concept is club convergence. That means the countries have made their club. Anyone who's part of the club will eventually become rich. Like the Quad or the BRICS, those who become a part of that club, they will benefit from it. All right. So many countries make a club. Clear. Then we discussed how government incentives for technology and knowledge, like how government giving subsidies for research and development, or tax benefit for research and development, or removing the trade barriers, no tariff. All of this will increase the growth rate. Correct. The neoclassical model's prediction in an open economy focuses on the convergence. If the economy is open, the the globalization will actually make the poor countries also come to the rich point. Clear? That is what the neoclassical theory basically propagated. Correct? So foreign investments will happen. That is what the neoclassical theory says. So it bases on the concept that the economy is open, no restriction. All right, correct. Eventually, these economies will develop and the growth will slow and will converge to the steady growth rate. This is what neoclassical theory said. Endogenous growth, on the other end, predicts greater growth with free trade and high mobility of capital. Isn't it? Isn't it? But here, all of this should put up into high innovation. Basically, this should lead to high growth in technology. And those firms permanently increasing the growth will benefit. So they say that there can be a permanent growth rate if there is substantial investment in technology. Okay, that is basically capital is moving into technology growth. Convergence, in terms of convergence, removing the barriers will benefit, right? It will increase the capital or movement, it will speed up rather the growth rate and the standard of living of the developing nations. Clear? Countries following inward oriented, okay, protecting domestic industries can expect slower GDP growth rate. So the countries who are actually protecting their domestic industries, putting a lot of restrictions on tariff like US currently, that might face slower GDP growth rate. All right. These are all your formulas that you should know. Now, see, all this you understood, and problem with economics is that there's a lot of theory. The first topic has calculation, the second topic has a lot of theory. But since in exam you're just going to have two vignettes at max, for sure there will be something similar to, I should not say for sure, but there will be similar to triangular arbitrage, cross currency, forward calculation. So that is going to take your substantial part. And some or the other aspects they might put about the currency, economic growth related things. I would suggest you to know the basic formula of Cobb-Douglas production functions, right? That is more than enough. The rest of the thing you can just read and go through. But when you revise it, you'll get summary of everything. You'll get that most of the times they're talking about the same thing. How total factor productivity, technology, capital, and labor helps boost the growth rate. Because you've learned all of this in detail in the full course, and now in the revision mode, you might have done the second or third revision. By now the picture would be clear that they're probably talking about the same thing, and it's so logical if you are watching the current news or current market if you are aware about. All right, now let's do the case studies to make it more fun. Got it? Yep.